Right now, major market indices are hitting all-time highs. For the millions of passive investors contributing to index funds every month, the wealth generation feels almost effortless. You buy in, look away, and the balance grows. But looking at market history, periods of near vertical, uninterrupted gains often mask a growing structural weakness. The steeper the climb, the more likely the foundation is beginning to crack. During the peak of the dot-com era, this euphoria was visible on the trading floor. On days when the Dow posted record gains, traders were literally clapping as the numbers surged. It was a moment of peak confidence, where momentum replaced math. While financial bubbles are frequently characterized as criminal scams or massive hoaxes, they follow a mechanical cycle of overextension. They are the result of a functional market being pushed to its logical extreme. The current market presents a specific challenge for investors. It requires distinguishing between the validity of a new technology like AI and the stability of the internal machinery pricing those companies. Every bubble begins with a logical breakthrough. This rational catalyst is usually a technological shift, like the dawn of the internet or the current expansion of artificial intelligence. The chaos of the New York Stock Exchange in 1999 was fueled by real capital rushing to build the physical infrastructure of the internet. This was not a hallucination. It was a massive deployment of human and financial resources to reorder global commerce. In this first stage, smart money identifies the innovation and flows into the sector. This initial wave of buying is grounded in reality, legitimately driving up prices as the market recognizes new potential. Because the initial foundation is rooted in a real breakthrough, identifying the exact moment the market transitions into irrational mania is nearly impossible for most investors. The engine driving the modern market is no longer just human sentiment. It is the automated logic of passive index funds and algorithmic trading. This creates a phenomenon called market concentration. Currently, a disproportionate amount of the S&P 500 is controlled by a tiny fraction of megacorporations. The feedback loop starts every payday. Millions of employees have their retirement contributions automatically funneled into standard index funds, regardless of the stock price. Because index funds are weighted by size, the algorithm is forced to buy more of the companies that are already the largest. This buying pressure inflates the prices of those top 7 stocks even further, regardless of their actual value. This aggressive concentration happens silently. Modern trading floors are digitized and sterile, showing no signs of the human frenzy that used to signal a market peak. Today's market success is less a reflection of a broad, healthy economy and more the result of an automated loop funneling wealth into a dangerously narrow point. This leads to the final mechanical stage, when the price of a stock completely detaches from the revenue the company actually generates. In a rational market, a stock's price is logically tethered to its earnings. This chart shows the green price line and the blue earnings line moving in parallel. Detachment occurs when FOMO takes over. Investors stop buying because of what a company earns today and start buying purely on the expectation of tomorrow's price, severing the link to financial reality. We saw this same mechanism play out in 2008. When asset prices completely detached from the underlying economy, the eventual physical consequence is a total market correction. When the primary reason to buy an asset is simply because it went up yesterday, the market has stopped being an investment vehicle and has become a pure momentum machine. A fully inflated, concentrated market enters a state of extreme mechanical fragility. It is a structure under such immense internal pressure that even a minor fracture can trigger a total collapse. The danger of market concentration is that the entire index is now dependent on a handful of stocks. If just one of those mega-cap companies misses an earnings target, the entire index loses its foundation. At that point, the algorithm runs in reverse. Automated sell-offs are triggered, and the same mechanism that pumped the market up now crushes it on the way down. To navigate this, you have to look past the broad headlines. An S&P 500 that is up is no longer a reliable barometer of economic safety. You have to look under the hood. Actively monitor the two mechanical extremes we've discussed, the level of index concentration and the detachment of stock prices from earnings. Understanding these hidden mechanics strips away the illusion of market invincibility. It allows you to recognize when the financial engine is no longer building wealth, but is simply building dangerous pressure.